Hi, and welcome to our end of August update from the Wealthy Doctor Institute. Intelligent investing for the busy professional. We focus on simple battle-tested methods of investing that require just one adjustment each month to protect and build wealth. I'm David A., author of my book, The Busy Doctor's Investment Guide, How One Adjustment Per Month Can Save and Maintain Your Portfolio's Health. Although the strategies in this book are easy to calculate and adjust each month, for those who are new to the concepts of this book, or for those of you who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. And for this month, first we'll go over the announcement of the month, and then we'll tackle a couple of more common questions. They're not earth-shattering questions, but they do keep coming up, so I'll address them again here. Again, review our system, starting with our 20-month simple moving average system. Then review the MRI system. Remind you about the rules of the 25% stop loss system if you insist on owning individual stocks. And then remind you about sector servers, since we do use that now as part of my collection of strategies. So the announcement, it's true. I did get interviewed on William Shatner's show last week. He has a TV show called Moving America Forward. He showcases entrepreneurs who are trying to help move America forward. And they found me, and I'm honored to have been on that show. They're in post-production right now and should be broadcasting in around a month from now. I'll post the link on my video on my website as soon as it comes out. Stay tuned. As for questions, our first one I'd like to cover is, people keep asking me, well, the Vanguard S&P 500 Index ETF is a VOO. Why do I keep listing the SPY on my videos? Well, let's think about this. Index fund, at least the S&P 500 Index fund, is theoretically the same as any other S&P 500 Index fund. They all follow the same index. These are supposed to buy the exact same 500 stocks in the same proportion. They may change a little bit in terms of relative fees among each family of funds, but they're all relatively similar enough that if you use one or the other, it shouldn't really make that much of a difference. Having said that, the daily volume of trading for the VOO is around 10 times less than the SPY. What that means to us retail traders is that if we want to buy or sell the SPY, it's a lot easier to get our orders filled at a more optimal price than would be for the VOO. Now, realistically speaking, the volume of VOO isn't exactly small either. There's around roughly 1 million shares traded every day, compared to SPY around 10 million shares. So if you have a relatively small account, and I'm talking about $100,000 or less, the VO, you should get roughly comparable fills as well. But, just in case you grow your account to a sizable account, you might want to consider using the SPY instead. Now, how about the difference between ETFs, the exchange-traded funds like the SPY and the VO, versus the mutual funds? Well, again, the mutual funds, they trade end of day only. So you don't have to worry about optimal fills with the mutual funds. However, you are stuck with just the end of day fills. Next question is, the 20-month moving average system says it's relatively safe to be in stocks right now, yet another system, such as the sector server StormGuard Armor, says it's relatively dangerous to be in stocks right now. Who is right? Well, let's think about this. People think about truth as a capital T. There must be one right answer. In actuality, all these systems, none of them are perfect, not even buy, hold, and rebalance. So what we try to do is we try to improve on the traditional model by imposing one or a few rules. Simple rules, more simple the better. And at least with backtesting, we've seen that we've been able to improve on market returns if we stick with the rules. Now remember, each system mitigates risk differently. So when one system says it's relatively safe to be in stocks, another one says it's dangerous enough to stay out of stocks right now, whichever system you picked to begin with, stick with that one system. If you stick with one system in one account, but another system in another account, it's not uncommon to have two different actions going on in those different accounts. And that's perfectly normal and reasonable, because what we're doing is that because no system is perfect, we try to diversify in terms of number of strategies. We don't try to diversify number of positions or mutual funds or ETFs or stocks. We try to diversify different strategies in different accounts. This way, again, it's the same concept of why we diversify to begin with. If any one system happens to blow up for some reason, it's not going to take down our entire financial health. So the first system that we'll cover is the 20-month moving average. So just briefly go over the rules. If the price of the S&P 500 index is above the 20-month moving average, it's relatively safe to stay in the index fund. Otherwise, get out. And remember, the 20-month moving average is our safety belt. It only works if we watch it every month. Just once a month, not more than once a month, but at least once a month. So here's our chart for this month. As you can see, the S&P 500 index fund is still peaking up a little bit. It's now at 201.05. It went up a little bit. And this red line, the 20-month moving average, is now 188.90. So if you take a look at math, 201 over 188, we have a approximately 6% cushion. In other words, as long as the markets stay above this line, it can drop as much as 6% by the end of next month, and we would still be in stocks. That's where our safety net is. If stocks go below the 6% cushion by the end of next month, then next month we'll get out of stocks. But right now, with this system, it's saying it's relatively safe to be in stocks. Next system is a completely different system. It's a system that involves more than two asset classes, more than two mutual funds, more than two positions. It's the monthly rotation investment system, abbreviated to MRI. So the rules for this one: every month we have 3 different mutual funds or ETFs. The S&P 500 Index Fund, which I use VFINX to calculate. The MSCI Emerging Markets Index Fund, which I use a VEIEX to calculate. And then the inverse S&P 500 Index Fund, which is the RYURX. Every month, rank the 3, sell the bottom 25% of your portfolio, and buy the top fund. And when you look at the data for this month, last month's data, this month's data, the S&P 500 Index Fund went from 200.79 to 201.05, rising 0.13%. Emerging markets went up 1.67%. The inverse fund went down 0.15%. So a graphical representation of the S&P 500 and the inverse funds have been pretty much flat. They traded place a couple of times, but it's been pretty neck and neck. But the one clear winner is the emerging markets. It did go up to almost 5%, but then went down to 1.6%. So that's the winner this month. So under the current model, last month we were roughly 3/4 in the emerging markets and 1/4 in the S&P 500 index. This month we sell the bottom 25%, which is nothing left but the S&P 500 index, sell that, buy the emerging markets, and we end up to be 100% in the emerging markets. Now, this is where the magic potentially happens. That's because we are now 100% committed to a trend that has been dominating for the last 4 months. That's why we're now completely 100% in that mutual fund. If this fund keeps its trajectory, then 100% of our gains will be tied to that one dominant fund. So observations for this month. The markets have been barely moving up. However, the emerging markets continues to dominate at this time. Next system is a 25% trailing stop loss system. So the 1% risk trailing stop, remember, if you really want to buy stock, limit your exposure or risk to 1% of your total portfolio. And you do that by, let's say, using up to 4% of your portfolio to buy that one stock and having a 25% trailing stop loss order. That means if the stock goes down 25%, 25% of 4 is 1. You only lose 1 in general. And of course, if the stock goes up by 33%, buy another block of stocks using another 4% of your account and update trailing stop order to reflect increased number of shares and repeat until stopped out. Now the next system, we only recently introduced this system, but it is a system that also mitigates risk. It's different enough compared to the other systems I've presented so far that it warrants having its own section. Now remember, every portfolio in Sector Server is different. I don't know what's in your portfolio. In general, what we do is we put in the mutual funds that are available to us in, for instance, a 401k plan, because they only give us so many choices to choose from. And this system will choose which fund is the dominant fund of the time period, and it will signal us when the dominant fund changes. You can customize this so that it only tells you once a month, for instance, because some mutual funds have a 30-day minimum holding time. Just be sure that if you do use a 30-day minimum holding time, be sure to at least take a look at the graph and see if backtesting that type of system really does work for the particular section of funds that you have. Again, this is a different enough system. It does require monitoring in that, yes, it will email you or text you when a trade needs to be made. However, just because I'm fastidious, I check this once a week just to make sure I'm not missing any signals. In general, the once a month signals, if you choose a once a month option, occurs either the last day of the month or the first day of the next month. So even though this video is using the August 31 data, sometimes the September 1st data on Sector Server actually shows us which trigger actually got triggered for that month. So in summary, remember, these are all different systems. Don't mix up the systems. If you use one system, stick with the rules of that one system. If one system says safe to be in stocks, but another one says danger Will Robinson, whichever system you're actually using for that one account, stick with the system. So we have so far several choices. We have the 20-month moving average. We have the MRI, the monthly rotation investment system. We have ways of dealing with stock tips, and then we have your individual sector server strategies. Keep those questions coming. I know I talk to several of you personally each month, but for those of you who have only heard about me indirectly, maybe you got a copy of this video forwarded to you by a well-meaning friend or colleague. Here are ways to get in touch with me. Seriously, drop me a line, give me a call, email me, set up a consult. A few of you I've talked to, you know your stuff, you're fine. I don't have to worry about you. But for some of you, holy cow, it's clear you need help getting your financial life in order. Don't be bashful reaching out for help. The more you delay, the more time is against you. So, until next month, invest safely.